Welcome to episode 2 of Savings Guru TV. I'm delighted to be joined by Julian Hynd today. I don't know if you want to do a quick introduction of yourself.
Sure.
And tell viewers about your background.
Thanks, James. So, been in savings since 2002 when I joined NS&I, National Savings and Investments. Did a number of roles there. Left in 2016, 2017 to join Ford Credit and led the development and the launch of Ford Money, of which I'm obviously very proud.
Yeah.
And most recently was at Volkswagen Financial Services, working on their savings proposition. And great to be here. So thank you.
No, thanks for joining us. You've got quite a distinguished career. One of the I got described as a veteran of the industry the other day, which I found quite hard to swallow at 42. But I put you in that bracket with me. You've been in the industry for a long while as well.
Well, the thing is, you're the savings guru. I'm just the savings guy. So not quite in the same league.
I wouldn't say that. I mean, there's obviously I'd say it's been a really exciting time to be in the industry. We saw Arbuthnot Direct launch last week. By my reckoning, the 42nd new entrant since 2009. Obviously, not all brand new banks. Some people like Ford have changed their license and European passporting, but still quite a large number. What do you make of their proposition and their entrance to the market?
So 42, of course, talks about Hitchhiker's Guide to the Galaxy, but we won't go there. In terms of them entering the market, I thought it was very interesting because they're more on the wealth side, private banking. But for me, this goes back to the financial crisis. So, when I look at the market, I'm looking at the market more from a structural perspective. And, what happened in the financial crisis, and putting aside the reasons for it, is the rules of the game changed and we became more sexy, right?
Yeah.
So retail deposits and savings are never going to be sexy,
No.
but they were sexier. And it came down to 3 things. One is the introduction of the HQLA, high quality liquidity assets, the liquidity coverage ratio, and most recently is the net stability funding ratio. So those 3 things have fundamentally changed the game. All banks now need to look at some sort of retail deposit funding because even securitized assets are penalized. So the fact that they've come in is telling. The way they came in is even more telling because they came in without a splash.
Yeah.
But that talks to the size of the market. So we talk about the cash savings market, 1.65 trillion. But in reality, once you strip out current accounts, because unlike you, I'm not big into current accounts, that's 800 billion. Well, if 800 billion is growing at 5%, that's 40 billion. You strip out the accrued interest, that's still 25 billion of brand new cash. If they come into the market without a big splash, that tells you there's more than enough funding for all of them. Because on top of that, of course, is our favorite friends, FLS and TFS, which have completely sucked money out the market. And until 2021, we're just not going to see that. So I think from a supply perspective, the banks need retail deposits, they need savings. But there's so much liquidity that they don't need to worry about putting the elbows out. Yeah. They've come into the market. I think you're probably one of the few people who picked it up. I don't think anybody else has spotted it.
Yeah, it's very, very low key. I think that's deliberate. My sense is that they're just going to test the water gently. They've pitched the rates just at the kind of bottom end of the best buy table, so a little bit of visibility, but not a huge amount. I kind of joke that page 2 of Google is where you hide dead bodies, and that's where you find Arbuthnot Direct. So I think that's why it's been missed, because it's the homepage doesn't even appear on a Google search. I think they're coming reasonably competitive. And you strip out the Islamic banks, they're actually paying a pretty attractive rate of interest. They've gone for the longer terms, which suggests that they're probably just going to pick a little bit of money up. They've not gone for the popular categories, test the water, and it'll be interesting to see whether they expand that out. They're on record as saying it's going to be used to fund potential acquisition. So it will be interesting to see. I guess we'll probably tell if they come in with a bigger splash or more products or better rates, that they're probably on the trail of an acquisition, which may be something that there'll be a an interesting thing to watch, because sometimes you can tell why providers come in and sometimes you can't. I think they're going to be reasonably obvious to predict, given what they're on record of saying.
But you've touched on a point which I think people tend to forget, is every bank does have a different strategy.
Yeah.
Now, retail deposits not all equal. They've talked about acquisition. We know that, for example, some of the kind of forward monies of this world is more about financing assets that they've already got, whereas somebody like, some of the newer challenger banks are focusing specifically on lending into the SME. It's all very different strategies.
Yeah.
But we kind of lump them all together in one pot and then somehow expect them to behave like one, which they don't, which for me personally makes perfect sense. That's why when I look at the rates, and I don't follow the rates nearly as closely as you guys, I'm more interested in what the positioning is. So, for example, when we launched Forward Money, we didn't come in with a big splash on purpose because we were curious to see what the market would do, how it would react, because it's much easier to recalibrate than to try and find a way of stepping back if you're coming too hot.
I think that's a really interesting point, because without sort of naming names, there are banks that have made that mistake of coming with a fairly aggressive splash and not been prepared to cope with that. And it was it's very noticeable when you entered that you, as I would expect, knew to avoid those pitfalls. But it's amazing how many haven't, and some have come particularly unstuck as a result.
I mean, some of them have got a balance sheet big enough to sustain it, and good luck for them. Some, unfortunately, I think, underestimate how much liquidity can flow to them and how fast. Savings Guru, many other like yourself out there pointing the way. It doesn't take very long for word of mouth, social media, and suddenly you're dealing with tens of thousands of customers, but your balance sheet's only a couple of 100 million.
Yeah.
That, of course, causes brand issues. And I think, so whenever somebody launches new, going back to them, I think that they've done it wisely.
Yeah. There's still apparently around 40 banks in the process at various stages. Obviously, I don't expect all of them to make it through the process and come to fruition, but potentially 42 new entrants, and we're still not that far through the process yet. Possibly is only in the middle of it.
It is fascinating, and you're my barometer on these numbers because I don't keep. But when I look at the size of the market, going back to the numbers I gave earlier, if you've got 25 billion new money, proper clean new money, and somebody comes into the market with a balance sheet, let's say 250 million, that's a lot of new entrants before you dent the new money.
Yeah.
Which is why I don't think we've seen any competitive pressure because of term funding, FLS. The big banks are simply sitting on too much liquidity. I think it's only from 2021 onwards, when that unwinds, that normality will return. I'm curious to see what happens at that point. Suddenly, let's say 20 out of the 40 that you've mentioned hit the market. That's going to be a very different market space to entering today, where you can be second page of Google and actually doesn't make a difference.
Yeah.
2-3 years down the line, I think it's going to be a very different space.
I agree. I think it's been really interesting. A lot of the commentary has been around open banking and the end of TFS and FLS, and we're seeing a kind of return to the market. But I think people have misjudged that. It's far too early. They've not appreciated that it's going to take time for that money to wash through the system. I agree with you. I think it's back end of 2020, early 2021, where we'll really start to see a change and that come to fruition. And I think that will also coincide with a spike in new entrants. So I think we've seen 8 as the best in a calendar year, and I think we could see that potentially in 2020 or 2021.
I would not disagree, because that's where I've got to, which is why when I look at the kind of headline rates, I don't get distracted by them, because quite simply, and even the forecast that you guys do, it's, the funding for lending in TFS, as they are unwinding, they're not doing it in a linear, it's not like, 4 years, 25, it's not working. In fact, quite a lot of it is still tucked away.
Yeah.
As that glacier starts to unwind, we'll start to see movement. If I was a challenger bank, I'd want to be in the market sooner rather than later.
Yeah. I think there's certainly some pressure coming in some of the ones that are coming through at the moment to try and push, and I know some of them are finding it frustrating, but having to work to the regulators' timescales and not being in control of their own destiny, which is obviously right from a consumer perspective and a system perspective. But I can well imagine it's quite frustrating when you're on the receiving end of it.
It is a robust process, and quite rightly it should be. But coming back to something I picked up when I was listening to you and Lee on your This Is Money podcast, I really enjoyed it, and for the viewers, I'd recommend you listen to it. Is comes back to though is savers should be saving. Yeah. You need to create that habit. Don't look at the external environment and get drawn into it. You know, in my head, I've always been very clear that there's a distinction between a saver and an investor, and I think a lot of people merge the two. As a saver, you should be building a pot. Headline rates shouldn't be what you're about. You should be trying to, regular savers, these type of things. If you're an investor, you want to protect your pot against inflation. That's a different mindset. In the current environment, I'd say to everybody, little, as often as possible, build the pot up, and by the time you've got a decent pot, we'll be into a different market, and then you can start to behave like an investor and maybe take some risk.
So, someone who's been involved in the marketplace for a long time, who would you say have been the new banks that have impressed you the most, and who you would say savers should take a look at?
So I'm going to be biased and say Ford Money, but I would, and to my ex-colleagues, I hope they keep doing the great job they are. But there's a lot of banks out there that I do admire. I've got to say I'm particularly fond of Monzo and Starling, but I like technology and I like shiny things. I think they're doing a fantastic job. I think at the same time we've got some of the other challenger banks who, like Metro Bank. It's a completely different proposition. They recently won some awards around service. I've been in many times and absolutely blown away how they operate. I'm a big fan of First Direct as well. So,
arguably one of the first challenges.
Absolutely, and what do? They do it absolutely well. I think this is the thing, is you'll be careful the fine line between coming in, launching potentially with high rates, drawing customers in, and then a proposition that doesn't meet expectations. My approach is just kind of simple, straightforward, and make it easy for the customers. So anybody who does that, I kind of warm to them.
I think Monzo's really interesting, and Starling. I think their time will come. I think they're starting to appear more and more above the radar, but I think for a long while they've crept along really nicely, building up. But what's really interesting for me in that market is you've got some of the big boys offering really big incentives in a cash sense to switch. I saw a new offer launched the other day, £150 to switch, and they've done it without playing any of that game. They've taken the view that they're going to build features and tools that are useful for customers and provide a really top end service that way, and move away from kind of, if you like, the gimmicks of here's a few quid to switch.
I've been talking for years, and I'm not a big fan of bonus rates in any form or size. And paying someone to switch for me is no different. It's just a disguised form of bonus rates, and I apologise for anybody who disagrees with me, but that's how I see the world. I genuinely think that if you are going to come to market, you need to have loyal customers. And the way to do that is to be consistent and sustainable over time. That was one of the reasons why when we launched Ford Money, we created the best rate guarantee, to say to people, we don't want to treat existing and new customers differently, and to try and build a fan base. And by doing it that way, you do. Whereas you pay money to switch, how loyal are they really?
No, it's not a long-term recipe for success.
No.
I'm going to bring you back to Ford Money, because I can't let you promote your former work without sort of sharing a few more reasons. You mentioned the best rate guarantee, but what else is it about what you delivered there that you think sets you apart from some of the other players in the market?
I don't think it sets Ford money, I don't think, is completely separate from the market. I think the proposition is what you see is what you get. There's no teaser rates, there's no bonus rates. It's an open, honest conversation with customers, and it doesn't penalise existing customers from new customers. And I think making a virtue of that was what made us different at launch. We were the first ones to talk about a best rate guarantee. But it felt right.
Yeah.
It was an honest approach. And, I remember having conversations with customers about, some of the things that we were doing. And when I explained to them in a nice, easy conversation how we were doing things, I think they were pleasantly surprised. And it's good to see a number of the other challenger banks starting to do the same thing. I think we shouldn't forget that there's 120 to 121 savings providers in the market at any one point in time. 7 providers control 68% of the savings market. Yeah. We're talking about the minnows, we're talking about the smaller ones. But I think all of us collectively, by behaving in the right and proper way, will change the market. It's kind of what you were saying on This Is Money. You and Lee were talking about your movement. Yeah. You haven't got a name for it yet. You've got to come up with a colour. We need a hashtag. We need a colour. But the movement should be, if all of us start to behave proper, then the cash market study and these type of things will fall away.
Yeah.
Because actually you don't need that. Yeah. Keep in mind that I remember the Sandler review of 2002, which was only 12 or 13 reviews ago, depending on which and how you count. I mean, that's how many reviews have happened on the UK savings market since 2002. 12 or 13, depending how you count them. I think if all of us just behave ethically and correctly, which is what the FCA want, and what our customers want, that's the way to change the market.
I agree. I think it's coming. I think it's just the regulator is trying to speed it up, but they're probably not the body that's best known for moving quickest. And I agree with you. I think the market will sort themselves out.
I will not comment on the regulators in any form or size. I think I have a
that's
long
probably
career.
wise. Yeah.
But at the end of the day, let's be honest. 10 years ago, bonus rates were prevalent, yeah. And for me it was the kind of offer drop, it never felt right.
Yeah.
And when I was at NSLA, we never did that. We had long discussions about it, and we just said it didn't feel right.
Yeah. I think we're very clear on the website. We don't cover the bonus rate accounts for that reason, because we believe that they come from a position of a starting point where they're deliberately not there for customers. They're coming from an unfair starting point, if you like. They're based on the assertion that we're going to drop it and you won't move, and we just think that's wrong. We make an exception for Marcus on the basis that actually, even if you take out the bonus, they would appear in the tables anyway. So that's one where we have made an exception. But I think with Marcus, in fairness to them, what they have done is they've gone back to where bonus rates started, which was, we'll give you a little sweetener to move, but it was a little sweetener. It was a bonus for a short period of time, or a small extra amount, if you like, a little extra reward, rather than now it's moved to, some of them you see the bonus rate is 5 times what the actual underlying rate is, and that just strikes me inherently as unfair.
But the good news is there's a lot less of it around, significantly down, and that's the industry changing how it approaches. The other thing I think I'd like to see changing slightly is the kind of aggregator space. Because let's be honest, the kind of money managers are starting to move in. Yeah. They're very big in Germany in particular, which is a slightly different market, but with lots of overlap. Looking 2-3 years forward with PSD2 or PSD3 or what other successors, I think that's another dynamic that's going to change the market and put the customers more in the power seat. And I'm not sure that we as an industry have yet thought through exactly what that means. I've been talking about it for a long time, but nothing's materialized yet. Yeah. So I'm hoping at some point I'll be right. But somehow that feels that's going to change things. And I think once customers start to take more ownership, and it was in the cash saving study, it was one of the things that they brought through, is if the consumer is more in control, going back to the movement that you and Lee want to start, I think they'll put more pressure on us to change. Yeah. So best be the change you want to be, rather than wait to be changed.
You touched on some of the kind of cash managers coming in there. I guess you've got you've got kind of a couple of sides there. You've got those that effectively charge the banks, your Asians, your deposit solutions, your Hargreaves, Lansdowne. You've got on the other side those that charge the customer, your Insignises, your Flagstones, etc. Where do you kind of see that space moving? It's not really gained a lot of traction. It's been a very slow movement in the UK, but you're right, incredibly successful in Germany.
Very incredible. So one of my previous roles, I was quite involved in the German market and what was happening. And for us, it was a barometer of what was coming. Not exactly, because even there's some things about how they operate that I think is quite old-fashioned, especially trying to go online. It's quite old-fashioned. But that market has continued to evolve. I think there are two existing markets, who pays, customer or the banks. My gut is that we'll see a number of different models come out. It'll be an issue around scale. I wouldn't be surprised at some point somebody will throw in some advertising revenue as well. Kind of a nice blended weight. Bigger question is who owns the customer? Because, if I go on to ABC Cash Management, open an account and they kindly move my savings around, my risk profile says I only want FSCS approved accounts, and they moved around and give me the best combined rate. Whose customer am I? And that's a question I'm not sure, because some of the challenger banks I think would be quite happy to be just a recipient of some nice clean retail deposit funding without having too much in between, whereas others are saying, well, hold on, my entire proposition is built around loyal customers for the long term. So going back to the FLS, TFS unwinding by 2021, the other converging trend is the cash managers. I know that some of them are building pots of cash up to do a lot more. I don't know. If you ask me which one I'm going to bet on, my answer is I'm gonna keep my cash and wait a bit longer.
Yeah, I'd agree. I think it's really hard to tell who's going to come in. I think the customer pays model potentially works better in a rising rate environment. I think that one of the barriers at the moment is that fee, although low in percentage terms, is actually quite a high proportion of the interest rate. It can be somewhere in the region of 10-12% of the interest rate. If we move to an environment where you had base at 2.5, and instant access rates around sort of 2 to 3%, and bonds in the 3 to 4s, suddenly that fee becomes a very small element of the interest, and then that maybe makes that model a lot more interesting. On the other side, the banking side, there's a reluctance so far for most of the banks to pay up for that. I think there's a feeling that, well, I can get that money in the market without having to pay that fee anyway. Which
is why then you get even a stranger wrong word, the other hybrid model, which is kind of what Starling and them are doing, which is the marketplace.
Yeah.
Again, that's another variant of how the model will work. I think ultimately it comes down to customer choice. I'm a great believer in the law of diffusion. So, product life cycle. So, let's be honest, my mother would still have a rotary phone if she could. They finally took it away from her. There's what is the progression of customers along their journey? And I think the banks that make it easy for customers, who have a great customer experience, will break that barrier, and then we'll see some momentum. But it could be 4 or 5 years before we see coming out the other side. But it's exciting times. Savings is not only we more sexy than we used to be, which is good. I remember the dark days of 2003, 2004. But technology is coming in a way that is changing our landscape fundamentally. It's going to keep you on your toes.
Absolutely. But it's interesting you mentioned about service there. I mean, we had a call in to the office a couple of weeks back from an eagle-eyed saver that had noticed that one of the providers had changed the rates before we'd been informed and been able to update our website and phone to kind of alert us. Very complimentary about what we do. But one of the things we kind of touched on was some of the providers, and he'd spread his savings around a number of them, and he'd been really pleasantly surprised by how good some of the smaller players were, and he tried a couple of the Islamic banks as well, and been particularly impressed by them, which is kind of an area where I would say they effectively still pay a premium in the market, because there's a reticence from some savers to go there. But it was really interesting that someone that here and all the things that we've seen in the industry, and yet good old-fashioned service was still the key driver.
But a rising tide lifts all boats. Each of the challenger banks is pushing the boundary slightly on the service side, and I think it's good for all of us. Yeah. We're not seeing that in the rates, but I think it's a completely different set of economics.
We've seen rates go up roughly about 0.25% last year. We started this year with some gentle ticking up as well. Do you think that's going to be a theme for the year?
Came back to my earlier comments. I think it's a glacier, and it's melting slowly, and until FLS completely unwinds and proper market economics kick in, where people actually need to acquire funding, I think it's going to be following base rates or slow thaw. But the trajectory is now up, but that's because we're so low, historical low. The speed of release, your guess is as good as mine, and I look forward to next year's predictions.
I've got reasonably good form with the Daily Mail doing my annual predictor. Yeah. I've gone for I think I said something around sort of 20 basis points this year.
Indeed,
I think it'd be a little tip out. We're kind of on track for that, and I think that at the moment I don't see any reason to change that. I think the thing that's only interesting for me at the moment, and whether this will be sustained or whether it's short term, is we've seen the Islamic banks continue to tick up recently, but they're following pack just drop away a little bit. If I look at the 1 year, we've seen BLME go top with 2.2, and actually the chasing pack of Islamic banks are still tucked in behind that, but then below that you've got a fairly severe jump back to 2%. I suspect that will be a short-term trend, and we'll tick forward again in the future. But it's interesting that kind of divergence is coming into play.
But again, this comes to what is their strategy and what are they doing? What is their lending book doing? How much funds do they have sitting? How much have they tucked away? How fast is it? There's so many different variables to this, which is why I don't track the price changes as closely as you guys. For me, it confuses me. I tend to look at it kind of once every 3 or 4 weeks, and I get a sense of what shifted in that time. Gives me a better sense.
It's definitely calmed down. It's much easier to keep more on top of now. I think if you roll back 12, 18 months, it was really tough, and you could put a rate out, and things change within 24 hours. I think it's getting much easier to predict. I think looking at week-to-week movements are a lot less.
But if you go back to 2005, 2006, before the financial crisis, whenever we were talking about making a pricing change, we invariably kept it at about 10 basis points. Nice and round and clean and easy to get. Whereas now we're talking about 2 or 3 basis points, sometimes bumping up 2 or 3 positions. And that level of competitiveness is indicative of almost the economics holding us at a certain point. Because if you went 3 or 4 higher, you'd suddenly jump 5 places. That comes back to what are they doing on the lending side, and how much do they need the cash?
So one question I always ask, which is, if you're a prime minister for the day, what would you change? What would you do in the savings market to make it better? So
in the savings market, are you keeping me? Okay.
Yeah.
Personally, I would review ISAs. When ISAs first kind of really gained traction in the early 2000s, I was and I remain a big fan of them. Keep in mind that about 30% of the total savings book is held in ISAs, so it is a very popular product. The plethora, the diffusion of ISAs in recent years is we're in the industry and I'm confused. I have friends and family who come up to me and say, "What do I do?" And that for me is a warning sign. So if I was PM for the day, I would review ISAs. I think I would rationalise them and go back to the original principle of what they stood for. I think I'd also try and find a way to explain to people how the PSA, the Personal Savings Allowance, fits in, because that came in 2016, and I remember lots of people saying, well, that means ISAs are dead. Well, they're not, because depending on how you do your calculations, between 40 for high rate and 70 for basic rate, an ISA is a great long-term savings vehicle. I would, without pre-guessing what I would do if I was PM for the day, but I would most certainly reduce the number of ISAs down to a more manageable number, and more importantly, an easily explainable number to customers.
I think that bit's the key for me. That's why I'm a big advocate of the same thing. I think if I can, sadly, I have to admit, I can remember the old Tessers and Peps, and the whole reason for those being scrapped and going with ISAs was about simplicity. It was about, here's, make it really, really simple, one allowance, pots within it, let's make it dead simple. And that has kind of largely stayed the way until the last 3 or 4 years, and then we've seen a plethora of the Help to Buy, the Lifetime ISA, alternative finance.
And the thing is, when you look at what the intention behind them is, it comes from a place of trying to help, and you think that's what makes it more complicated. Is it's touching on things that customers really want and really believe in, and that's where the confusion stems from. Personal savings allowance, which has made life a lot easier for everybody, which is a great thing, has also muddied the waters. So you have too many ISAs and a personal savings allowance, and depending on the prevailing best rate for 1 and 2 year bond, the number keeps moving as to whether you should have your savings in an ISA or not. That's a confusing place to be as a customer. Keep in mind, going back to, I know you believe in this, which is just get in the habit of saving. And, nice, a little on a regular basis is the way to go.
Yeah, absolutely. And I think that's a shame with the cash ISAs in particular. I think you're absolutely right. The waters have been muddied and people don't really know what to do now for the best. And the whole purpose in the first place was, let's make it nice and clean and simple, this is your kind of go-to place to start with. Now it's not so easy to call which that is, and it's much more kind of dependent on your circumstances. And if we want the nation to start saving more, which I think most people do, that's an area that needs addressing.
It is a generational thing. As we get older, we free up cash and we need to save. But what we want is the habit to be formed much younger. Yeah. And the way to do that is to create something that is simple, easy to understand, and actually rewards that habit. And I think we've lost our way.
It's been fascinating chatting through to you. Thank you ever so much for joining us today. It's been a really insightful interview. I'm sure the viewers will enjoy it. So thanks very much for coming on.
Thank you very much for being here, and I'm going to hold you to my mug.
I will definitely sort you out with a savings guru mug.
Thanks, James.
Cheers, Julie. Thanks a lot.